Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. We are back with his Monday expert, Taylor. How you doing, buddy?
Doing great. Thanks so much for having me, Michael.
Yeah, so we're going to get two topics in today. I think the first one just needs to be an understanding that June 10th is going to be a very important day for the stock market. I think there really are two outcomes from June 10th, either validation that peak inflation is in and the Fed could start pausing, or inflation is not conquered, it's not peaked, and we still have bigger problems. Because based on June 10th, I think one of two things happen, and they're going to be spectacular one way or the other. We get this spring loaded up, or we get the capitulation down. Do you see it the same way?
Yeah, I think you're right, especially if it's any bit of a sizable movement one way or the other. I mean, it'll be interesting. To your point, if you see a 0.5% higher, 0.5% lower, it'll be a crazy move in the market. But yeah, it's kind of a binary outcome where we hit that peak and we start to roll over. And now do we continue to roll over, and that's my perspective.
Yeah.
And we've been very vocal on this. And
Yes.
Your perspective is we hit it and it inflects back upwards, which will be a scary proposition because I don't think that that's the direction that the market is anticipating. And obviously we know the market is pricing things in before they happen. So I kind of, the tea leaves say that the market is anticipating it to continue to trend downwards and inflation to slow from here. But you could create a good case on the other side of it as well. And again, that is the camp that I'm in.
Yeah.
I know you're in the opposite camp.
Yeah, no, and I do think June 10th is the day, and I am seeing more and more money, right? More and more players in the game who talk to me offline. They're lining up behind you. I would say 8 out of 10, so 80% of the people are setting themselves up, to get, let's just put some numbers on it. They think CPI will be in the sevens, which 8.5, 8.3, anything's in the sevens. And again, it's not about the 7.9 or whatever it's called. It's about what that gives the permission for the Fed to do.
Yep.
It gives the Fed permission to say, okay, here's your 50 for June. We told you it was coming. Here's your 50 for July. We told you it's coming. But September, we're not sure. It could be a pause. It could be this. It could be that.
And it's interesting. So you can keep track on a daily basis. The CME keeps track of where the market anticipates rates to be at the end of the year. Mm-hmm. And so you have seen one and almost a full two rate hike movements of 25 basis points being pulled back from the peak.
I agree.
Yep. So you're seeing it draw back, and that kind of states the same direction that you're speaking to, Michael. An interesting thing that I just landed on the other day was the fact that you've actually seen now peak gasoline usage. So peak gasoline usage came and went. We're at I didn't state that correctly. You're actually seeing a low watermark for gasoline usage outside of pandemic back to 2013. Mm-hmm. So, the whole kind of adage in the, industry of investment is high prices fix high prices.
Yeah.
And that's what that's saying. So like, if you're at a low watermark right now for demand on gasoline since 2013, almost a decade ago, then obviously that's people now making decisions predicated on the gas prices that we're seeing, which are exorbitant. Don't get me wrong. And it's, people are now looking at themselves for the first time in a long time going, maybe I don't want to go out to dinner tonight. Maybe that's a little added expense in the gasoline just getting to dinner, which is going to cost me more. That now, let's pump the brakes on it.
No, there's no question that discretionary spending is happening at accelerated rates. The first thing people are cutting back is eating out. The second is less driving. And we're talking greater than 50%, right? There's been some research I talk about in my daily financial news. It's happening. Mom and dad are making decisions, and eating out's the first thing to go, and driving less is second. So yeah, it's happening right now. And as far as gassing, dude, I just paid $6.59 a gallon.
I'm sorry. Everyone, wherever you are, bitches about how bad it is, but California, it's really bad.
Yes,
it's really
just
bad.
nuts.
Yeah, you guys get twofold. You guys get, the $6 a gallon gasoline, and then you also get housing prices that are. I know at the beginning of this year, the National Federation of realtors expected the median house to go to $834,000 in your great state of California. Now I don't know where that's moved since the beginning of the year, but that's where it started out, and those are just. those are crazy numbers.
I agree. Yeah,
The average household income, for context, is sub $70,000.
yeah, the math doesn't work. The math doesn't.
It really doesn't work. And you know what's interesting, and this is kind of all in the same vein, is that when we just, you know, are coming through a little bit of earning seasons here, what you're hearing is that so big retailers like Target and Walmart, which obviously are more focused on the lower end of the market,
Mhm.
struggle, right?
Yeah.
And then you hit some of the other higher end type consumer products, and they aren't struggling. And so what that's showing you, you know, like a really good one is the home builder Toll Brothers. Toll
Yes.
Brothers is obviously the high end of the home building market. They just showed really great earnings. And what it's showing you there is that inflation, unfortunately, is a regressive tax. So, you know,
It is and has always been a regressive
correct.
tax.
Correct. So, you know, you as a high, you know, a lot of people as high income earners, the $6.59 a gallon is the same as the low income earner, but it's 10 times more expensive for that low income earner because that may be 1/10 of what they have in their entirety of their bank account.
Yeah, the discretionary income is something I talk about. And it's really funny when you talk about wealth and all of this stuff, people talk about high incomes and all of that. It's for me, it's all about discretionary income. In private companies, it's the burn rate, right? Positive cash flow, all these things that are now suddenly cool again, right? It's not 100 IBs ARR. It's, you know, it's being cash flow positive, but you got to watch the discretionary income and it's just a sad fact that 30% of American consumers aren't really impacted by $6 gas, right? Discretionary income, they're going to go travel, they're going to do all these things. But that means 70% of our population is. That's a huge number. They're eating out less, they're driving less, they're trading down in food. And it's really interesting, right? I talked about it on my channel. I think we have a K-shaped summer going on where if you're in the 30%, party like it's 1999. That's why Macy's talked about event-based closing. That's why Nordstrom talked about same thing, where Walmart and Target are like, people stop shopping, right? You don't need another TV. You don't need this. They're trading down. So it's really interesting. And this all goes back to June 10th. And it's funny because, again, I think the stock market is, so the stock market is not the economy and the economy is not the stock market. The stock market is often a forward leading indicator. I get the feeling that there's a lot of Wall Street, i.e. the forward interest rate that you talked about. There's a lot of money setting up for a June 10th bounce.
Yep. Yeah, I don't sit in that camp either. So I know it's weird to say that, like, Taylor, you're talking out of both sides of your mouth because you think inflation's not going to be as hot and is going to be cooling. And at the same time, you don't think that we get this gangbuster return out of the stock market, which to your point, I think that is setting up that way. I think we have, you know, the bear market bounce happening right now. I've stated this for, you know, the entirety of the time you and I have had conversations, which is a few months now, that I think the economy is actually weaker. And I think that what you're going to see is—
We actually agree there. Yes.
Yeah. So, and I guess where we differ between you and I is that I don't think the Fed can be as aggressive because I think the Fed is going to break the economy. So I might think the economy is actually slightly weaker than you because, again, if the Fed raises rates too quickly, they're going to break it. And I think we both are in the camp that they're going to break it.
Yes,
and a
we
recession will come. It's
Yes.
just how quickly and how significant is that recession going to be?
You think
So
it's still this year?
Yeah. Go ahead.
Yeah, that's. It's funny how we see it the same way. It just the dominoes fall in a different order and different rate.
Right. Yeah. And so, I mean, everything about kind of the economy in general and the forward looking mechanisms, et cetera, and how the stock market reacts is all based upon rate of change. It's not based on outright, is it positive or is it negative?
Exactly.
Like, you know, the really easy example to look at right now is like, even if inflation came in at 7%, which it's not going to do, but say it came in at 7%, which is so low.
Yeah.
That's still a really high number.
That's still really bad. Yeah.
The market would have a field day with that. It would be off
yeah.
to the races with that. Boom, explosion upwards because the rate of change is then going to be significant slowing. So it's all about the rate of change rather than just an absolute positive or negative number. And, you know, the Walmarts of the world, the Targets of the world that are showing slowing on the lower end spender consumer is telling me potentially that inflation is going to cool more quickly. And that's my expectation for June 10th. But that's not to say on the other side that means the economy's stronger.
Exactly.
right?
No,
So
it doesn't.
you're
They're not
seeing
connected. They're not connected, folks. Don't connect them. Yeah.
right. So that's why I say that, like, I think inflation can come in weak, but inflation coming in weak can also just mean, the economy's not quite as strong as what we think it is. So that's why I think that, you might get a rally on inflationary numbers coming in weak, but at the same time, that also shows the economy's weaker. And I think
Yeah.
that is a result on the market that forced it down further.
Well, let's flip the coin over and go the other side and for a moment pretend you're wrong. It seems like again the market is set up
It's
where,
never happened before, ever.
it's never ever happened. I got to talk to your wife because I'm sure it's happened once before.
Gosh, she'll show my batting average is not very good.
So let's just pretend it, because again, I think if it's 8.3 or above, the market will not like that. Because again, if you play that out, because again, the Fed meeting is post June 10th, the Fed will come out and say, here's your 50. We're going to give you 50 next month. And oh, by the way, you can expect more 50s after this.
Yep.
And the market's not set up.
Yeah, I mean, when you look back just a couple weeks ago at Microsoft said they're going to nearly double their budget for salaries, and it's like, whoa,
Woo!
okay, hold on. And so, you play that one out and all of a sudden you go, okay, now people are going to have to start to get paid more in order for employees to be retained places because the market is so hot from an employment perspective. I know this is part of your case, and Microsoft is singing that tune to say, we're going to have to start paying people more in order to retain them as employees.
Apple just said it last week. I think it was Monday. Apple's not only raising corporate, which everybody thinks, they also said corporate and Apple stores, right? Retail clerks, Genius bars, all of them are getting raises. This is the this is my wage inflation is sticky. It's going to be with us for years to come.
Yeah, I mean, that call is looking great right now. I take the converse of that side, that I think that the FANG names are part of the very few that are able to actually stomach that. They're the very few that have the cash in the coffers in order to retain employment, et cetera. And maybe I'm wrong. Maybe we'll see that that even down to small businesses. But small businesses on the other side, like small business, the Conference of Small Businesses, the NFIB, runs a survey, National Federation of Independent Business, something like that. Anyway, NFIB, which focuses on the small business owners, they're more bearish right now than they were in 2008.
Wow.
It's like, whoa, then 2008, when the world was collapsing, the financial crumbling of the underpinning of our entire banking system was in question.
Wow.
So yeah, it's, you got things going in weird directions right now. And that's why, like, I feel for investors right now, because there are so many prevailing winds going in opposite directions. It's like you're, a hurricane coming from one direction and, sunny skies coming from this direction. And you could play out a scenario where either one of them is right. We sit in the camp that it's going to continue to be rough waters moving forward.
No question.
That's not to say that we're absolutely dead correct.
No, I'm wrong all the time.
Yeah.
Yeah. It's about probabilities, rate of change, things of that nature. And again, we look all the time and stuff changes. I mean, 3 weeks ago, people were talking about Fed funds at 3% at the end of the year. Now they're at 2.5, 2.75. So this stuff changes all the time. This has been an exciting conversation. I'm going to talk about pre-announcements in video number 2, but where can people find you?
Yeah, find us at Life Goal Investments on Instagram. We're on all platforms, but Instagram's the one we're most frequently posting on. Daily stuff, rules of thumb on investing, etc.
Yeah, check them out. I look at it every day. You guys are doing good work, man.
Thanks, Michael.
Mm-hmm.